Hi, I'm John Byrne with Poets and Quants. Welcome to our Thought Leadership Series at UC Davis Graduate School of Management. Today I'm speaking to a professor who has done a lot of work in the area of impact investing and many other fields. Let me introduce to you Ayako Yasuda. You received your PhD from Stanford.
That's right.
And then you started your early academic career at Wharton.
Yes.
And then you came to UC Davis in 2009.
Yes, I did.
And during that time, you've done a lot of work in the area of private equity, venture capital, financing startups.
Yep.
These are all really cool topics.
It is. I love teaching those stuff.
And these are things that young people are very much interested in.
Yes.
So tell me, let's start from the beginning.
Okay.
And how you got interested in wanting to become an academic, because you received your undergraduate degree in quantitative economics from Stanford, and then went to Goldman Sachs and worked as an analyst in their investment banking division before going for the PhD. But what was it that made you think, wow, the career of an academic is the career that I want?
Yes, I think it became more clear to me as I got older who influenced me early in my life. So I think it started with my uncle, who was a professor. And I would visit my uncle and aunt in their summer home during the summer when the school was out, but my parents are still working, so I would be sent there. And I would bring a lot of my books. I was 7, so I would read my books next to my uncle. And he would spend his day reading, thinking, and writing his books, and he would publish books with his name on it. And as a girl, you know, as age 7, I looked at their life and I thought, wow, this is fabulous. So that was sort of imprinted in me early on. And then later, I had a very excellent middle school history teacher. I think he really impacted me, opened my eyes to the power of research. And he would teach, I was growing up in Japan, in Tokyo, and he would teach a version of Japanese history that textbooks don't really cover in detail, but it was very historically true and important. So it was kind of a courageous thing to do, and I think he taught me the importance of discovering and speaking the truth.
Right.
And then finally, the most obvious influence was my undergraduate Professor Aoki, whom I had as a sophomore at Stanford University. His economics class inspired me to study economics as an undergrad. And although I went to Goldman Sachs against his recommendation to go straight to grad school.
Is that right?
Yes. 2 years into it, I realized, well, he was kind of like, you know, he was kind of right in that.
He knew you better than yourself at that moment in time. Huh?
I think he saw that. He saw that in me, and it meant a lot to me. And that's when I decided to apply to grad school and went back to PhD. I never looked back because I knew that I loved research, and I wanted to be like those people who inspired me.
What was your dissertation on?
My dissertation was on competition in banking markets. So at the time, there was a deregulation in the US.
Right.
So breakdown of the Glass-Steagall, and investment banking and commercial banking were merging. And this was an area I had a lot of practitioner knowledge in from my days at Goldman. So I think it did influence the choice of my thesis. I was able to combine my academic training as a grad student with my practitioner knowledge, and in ways that pure academics wouldn't really see. So I wrote a dissertation or job market paper about commercial banks' ability to leverage their relationship banking in winning bids in underwriting markets.
Right.
Yeah.
And then your research interest evolved over time.
Yes.
Because you've explored financing of startups, you've explored private equity, you've explored venture capital, and more recently you did a paper on impact investing that won a very important prize in sustainability, sustainable and responsible investing.
Yes, the Moscovitz Prize.
Yes,
yeah, we
congratulations
were very honored.
on
Thank
that.
you. That was a a real honor.
How do you jump from one thing to the next during your academic career?
That's a good question. Some of them you kind of stumble upon it. For example, venture capital. When I started teaching at Wharton, business schools didn't teach venture capital before that.
Right.
But it was right after year 2000, so everybody wanted to learn what is this new thing called venture capital. So they asked me to teach a course. And I came from Stanford, so maybe I had some sort of a geographic cred, but not a ton of practitioner knowledge. But after I taught for several years, I thought, why not do research? And I started doing research, and I also wrote a textbook, MBA level textbook. And writing that book also helped me really think about it as a more academic subject. So starting to do that. And then venture capital sort of bled into private equity. I think impact investing, my recent interest, again, came from my existing interest in venture capital, because I think impact investing is a topic that a lot of people are interested in, but a lot of people are confused about, and often it's confused with ESG investing, but they are very different. And impact investing, in a way that's done most commonly, is in the private markets. And because venture capital is private capital, some of the most well-known impact funds were VC funds. So I knew a lot about VC funds, and then I can study impact funds in ways that people are trying to understand sustainable finance from public equity markets can't really get hands on.
Yes.
So I saw this is a great new topic, and I was very curious, can sustainable finance really make a real difference? Because there are skeptics as well. Is it really something that can have a broader impact on the society and the environment? And here is a great way to actually answer that question.
Now, I think one of the things you discovered is that impact investing funds have a lower internal rate of return than traditional venture capital funds.
Yes.
Does that matter? Because the other less tangible benefits of investing in an impact investment fund may matter more to the individual investor than the actual return.
Yes, I think that's exactly why it matters. But I want to be a little bit careful here, because there is also this notion of doing well by doing good. That's like a mantra.
Yes,
and
indeed.
so that we are really clear of what I'm trying to say is the importance of this finding. Can I step back and talk a little bit about what I think are often lumped together, but really different things? So impact investing is investing with explicitly dual objective. So dual objective being trying to get a financial return and also generating positive impact, social impact or environmental impact. And related but different are something called socially responsible investing and ESG or ESG aware investing. So the first one, let's call this person Sam. So Sam has a lot of ethical principle. So for example, he feels it's ethically wrong to invest in private prisons. Okay, so he feels that I don't want to include private prison operators in my portfolio. So that's how I want to exercise my responsibility. Sam is a socially responsible investor. And this could be, a lot of people would say the same thing about gambling or more recently, I don't want to invest in fossil fuel.
Right.
Right. So that's
Right.
that's the class of investment that's practiced through exclusion. I don't want to invest in something. Now, the second person I want to bring up is, let's call her Inger. And Inger wants to make clean water access more equitable for all societies of all different backgrounds. And so she wants to flex her financial muscle by backing startups that do that. So they might invest in companies that build and distribute water pipes in developing countries where piped sewage is just very not that widely available. Or you might be able to do more rainwater harvesting, and that would conserve a lot of water, and that's actually relevant here in California too.
Yes.
So that's different between Sam and Inger is what I call a impact investor, because you're allocating to solution, whereas Sam is like he has conscience that he needs to alleviate.
Right.
You know what I'm
Yes,
getting
yes.
at? So one is like a positive tilt to something that she wants to allocate. Some wants to alleviate conscience by eschewing something.
Yes.
So both ethical, but practice kind of opposite ways.
And then you have ESG.
And then you have ESG, exactly. ESG, so because ESG, I'll call her Ellen, okay? Kind of easy to keep track of. Inger for impact, Sam for SRI. So Ellen for ESG. So Ellen is very concerned. She feels like, oh my goodness, there's a lot of disruption because of climate change, and we need to adapt to climate change. That means the whole economic system is decarbonizing. There's a lot of risk that my portfolio is exposed to, and I want to climate proof my portfolio.
Minimize your risk.
Minimize and manage my risk.
Yeah.
That's ESG related risk. So Ellen wants to manage ESG risk. That's her goal. So 3 investors, very distinct investment objectives, all very valid.
Yes.
But they don't necessarily agree on what to invest or what to not invest. But they're all sort of called under this big umbrella of sustainable finance. And that's a big problem, because I think when we don't distinguish between them, every time we lump them together, or we talk about one result but then stick a wrong label to talk about it,
Right.
we amplify the confusion. So like one common confusion is to say that ESG funds that invest in stocks that are highly rated, ESG rating-wise,
Yes.
if you find that they don't generate positive impact, you can't conclude that impact investing doesn't work, because these are not impact funds.
Right.
They are catering to Ellen. They're not catering to Inger. So that's one very common confusion.
And as you pointed out earlier, ESG and responsible investing, socially responsible investing, are more likely to occur in a public
Yes.
setting,
Yes. much more
where
common.
impact investing is more likely to occur among venture capitalists, and therefore it's less visible
Yes.
to the public.
Yes, less available
Yeah.
to investors who might feel like Inger, but given the non-accessibility of venture funds, they might end up looking for things, and what's called sustainable. Morningstar might say these are sustainable funds, and they might decide to invest in them, thinking that this is making a difference for the world, but what it might be doing instead is mitigating risk for your portfolio.
Right.
Right. So there's this mismatch that I think a lot about the role and the responsibility of finance as a matchmaker between these different types of investors with their own objectives and the companies and or startups that want to achieve these goals. And I worry that this great confusion around ESG, we might be mismatching, doing a bad job as a matchmaker,
Yes.
if you will. And so I think another kind of confusion is a lot of people say that divesting from oil companies doesn't make the world greener. And that's probably true. But then you can conclude that impact investing doesn't work because divestment is not impact investing. And then, this is a long way to answering your question, but why my research result matters. There's also, in a public equity, people find that if you invest in ESG funds, some people will find that you earn just as good return as you invest in traditional funds. And that's where the doing well by doing good comes from.
Right.
And that's probably a reason why asset managers love to say that, because that's like, why not have
Yes.
both of best of both worlds? But there is a mistake in saying that, because ESG ratings are not measures of goodness of the companies to the society. They are actually measures of how resilient the stock is to hold up its value against all the ESG related risk.
Right.
So it's about the sustainability
Interesting.
of your portfolio
Yes.
that it's measuring. And that's what they say if you go to the rating agency website. But again, something gets lost in translation, and a lot of people who see the message, and I meet a lot of people who tell me that I thought ESG ratings measure goodness of companies. And so this is, if you show that doing well by doing good is the norm, then two dangers. One danger is that some people look at that, like finance people who think that's not possible, look at that and think, oh, this is a proof that all sustainable finance is greenwashing. It's just marketing.
Yes.
And be very cynical about it. And another danger is to say that, look, since we can do that in public equity, then why do I have to sacrifice any returns to really do good? Right? And then, so those are the two confusion that I think it's really important as academics to articulate and point out that, in a way that maybe people in asset management might have a difficult time articulating for various incentive reasons. So coming back to the paper, I think it's important because we, unlike ESG funds or divesting, we actually hand collected and study impact funds. So these are funds that are VC funds that invest in startups whose very business idea itself is supposed to generate impact. And we find that investors in those funds are willing to pay for the positive impact by accepting lower financial returns. So I think that shows that people like Inger type of investors are, they have, I'm sorry to use that sort of technical jargon, but utility, they have this known financial utility when they see that positive impact is generated. Like they value the outcome in and of itself. So they might not be wealthier, but they are happier.
Right.
And
so they're getting psychic income.
Yes, and
in effect.
What is I think it's, we often in finance equate happiness with dollar, and it might be sometimes a good approximation, but ultimately we all maximize our own utility, our own happiness, and we define it in many different ways. Like none of us purely, I mean, if I did, I would still be at Goldman Sachs.
Now, socially responsible investing has been with us for a long time. Mm-hmm. There are people who didn't want to invest in companies that were involved in companies that countries that practice apartheid, or tobacco companies many, many years ago.
Yes, that's the longest tradition.
Right, and even ESG in terms of minimizing your risk. While our definition of ESG has changed over the years, there are certain companies that wanted to minimize environmental risks, certainly in the past. But impact investing is the new and hot field. What makes it so hot? Is it a generational thing? Are there newer generations of investors who are very concerned about what impact investment has ultimately on societal's problems?
Yeah, I think one key word is externality. So externality is, let's say, the companies reduce pollution, that cleaner air or cleaner water benefits everybody, not just the company shareholders, not just company employees, not even just the company customers, but the whole community. And I think socially responsible investment, although it has a long tradition as ethical, the big difference is this way of Sam's way of doing protesting against apartheid. It's about how you feel you're doing the right thing. So it's about input.
Yes.
And in the philosophy, it's deontological, or I think Kant is the philosopher who espoused that. And that's also very important. We all want to feel we are doing something right. But impact investing is, I think you can call it being more consequentialist. What is the outcome of my investment? It's not about how pure I feel, but did it actually create benefit for the community or for the environment? And I think there is a generational shift to focusing more on the outcome.
Yeah.
And maybe some people say some of that's also related to, let's say, tech billionaires becoming philanthropists, and they're doing a lot of impact-related investments, and they bring a similar sort of output-oriented way of thinking. That may be. But I don't want to attribute it entirely to tech billionaires. I think there is a more broader generational preference in younger people, millennials and the Gen Z, to be focused on the outcome rather than just intention.
Right.
And that's an interesting distinction again.
Now, there are relatively few people who can invest in a VC fund, which often requires a very significant investment, and your ability to lose it without losing all of your assets, right? Given requirements.
Right.
So does that naturally mean that in impact investing is less accessible to an average investor than other classes?
I can give maybe like a two-part answers. I think impact funds as VC funds does remain less accessible than, say, investing in a mutual funds that do exclusionary screening. There are some more retail-oriented VC impact funds that start at $25,000 or so. So it's still large, but not as large as $1 million minimum.
Right.
That said, I think one other really interesting finding in our paper is that willingness to pay varied a lot. And I want to highlight pension funds as a possible channel through which we as a society could invest in impact. Because a lot of people who are everyday people are beneficiaries of pensions. They don't necessarily make the decisions, but actually pensions were so instrumental in the rise of VC in the US. So one small change in the rule in the late 70s that allowed pensions to invest in venture capital immediately meant much larger capital flew to VC, and the US VC industry in Silicon Valley today came to being.
Yes.
So pension is, I think of it as this intergenerational capital, and if we tap into that to invest in something really innovative and really have this dynamic effect, it could reap huge benefits. And right now, we had this opposing results in our paper for pensions. On one hand, pensions are often politically pressured to contribute to economic prosperity, especially of their region. So they do invest in community-oriented impact funds. But on the other hand, we find that European investors are much more willing to pay than Americans. And part of it is because pension included, a lot of US investors have this really strict fiduciary duty definition. They can't really consider non-financial factors when they make investment decisions. So they're supposed to make purely financial decisions when they invest. But what's a purely financial decision? Short-term financial return maximization could also mean long-term return destruction if we are not allowed to consider the impact of company activities on the social or environmental impact in the long run, right? So this very strict fiduciary duty that US has, that Europe does not have, we find that it's restricting pensions not to invest in impact, all else equal. So similar to what happened in the late 70s for the VC, like birth of VC was helped by pensions. Pension might sound kind of boring, but they are a very important source of capital.
Absolutely.
So in the 21st century, I think a potential paradigm shift could happen if a change in a rule allows pensions to invest in impact funds without breaching the fiduciary duty.
I would think that one obstacle to a major change like that is the way we think of success financially.
Right.
Right. I mean, fund managers are routinely judged by the returns they provide. And when you look at those returns, they do not account for, let's say, returns given to society.
Right.
They only account for the
What
actual
you
rate of
capture.
return that an investor gets.
Yes.
So to the extent that your success in the field is measured by what is your return to investors, there seems to be automatically then a discount,
Yes.
at least psychologically, to impact fund investors and allocating too much money into that category of investment.
I think that's true, and I think that psychological notion, I think it gets amplified in public stock markets. So it might be easier in private ownership. We also find that if you are mission-based organizations, you are more willing to pay.
That makes sense.
So it makes sense. You
Sure.
are able to justify because you're in a business of measuring non-financial outcome.
Right.
But if you're facing this millions of public investors in the stock markets, that's when it becomes very hard to have this dual objective.
Yes.
So I'm just to give one example, I'm currently doing a project, giving students a project, and they're valuing, one of the companies they're valuing is Sweetgreen. Do you know Sweetgreen?
No, don't.
It's a I guess a casual lunch food restaurant chain, but they received some impact investing as a private startup, and they're healthy, they're sustainable, and they also prioritize sourcing food from local supply.
Right.
So these are all, customers get healthy food, so that's a direct impact. But there are also other public good
Sure.
that customers did enjoy, and they did well enough, so it went public a couple years ago at a very high valuation. But now the valuation is not so high, and the question is that a fair valuation in a public stock market?
Yeah, interesting.
And it's also true that because the stock price has gone down, the company is now discussing ditching some of those non-financial goals in order to thrive as a public company.
Right.
Right? So exactly to your point, when you're faced with this competition that's real time, minute by minute, every day, you see the stock price I see it's a harder thing to do perhaps, and perhaps in the hands of private owners who have articulated dual objectives. It might be where, when you see a return differential, that might be where it can be more sustainable. But I also give you a second answer to your question. What can we do in public markets? Activist ETF is another example where these are ETF who may target index. So the return they're trying to track is just the index return.
Mm-hmm.
And as long as they're tracking index return, activist ETF of the impact fund type, would try to use their voting power in proxy to nudge the management towards better practice in
Sure.
social or environmental. So that's an interesting model,
Yes.
because they are not trying to beat the market, they're trying to track the market, but they're asking investors, if you put your money in our ETF, then we will gather our voting
Right.
power to exercise and nudge the management towards what we believe is generating a better impact. So that's something that everybody can participate in.
True.
And it's very nascent at this point, but I think it has the potential to introduce this type of dialogue to mainstream public market.
I wonder if what we need is an assessment of the value of the social good an impact company does. Because then that can be applied to the actual return and make the lower return appear much more acceptable to an investor
Yes.
than otherwise.
Yes.
Right?
Yes.
Because there obviously is value that's uncaptured
Yes.
by the social good a given company may be providing. And if that can be somehow measured in a way and tacked onto the actual return, I think it would make the stock much more palpable, the investment much more palpable to greater numbers of investors.
I completely agree. I think that's the next challenge that impact investing sector faces, is coming up with measurements that are somewhat universally accepted
Yeah.
and measurable.
Yep.
That's where the battle is. I think there are attempts to measure things, but when we have hundreds of different measures and each picks different measurements, it becomes very difficult to do the type of standardization that we take for granted
Sure.
as financial investor.
Yeah, and we're talking all aspects of society and the different difficulty of measuring all of those things.
Yes.
Yeah.
So research, I think, needs to go there. I myself am trying really hard to come up with clever measures that we can say, establish in an academically accepted way. Yes, this generates impact, compared to investments that don't regard this as a goal. So I think academics do play a role there,
Sure.
and once we start to document these things sector by sector, maybe it could become more accepted in practice as well.
Now,
Yeah.
impact investing is not a fad, is it?
A fad that it fades. That's
Yes.
what you're implying.
Or do you think there's tremendous growth ahead for impact investing? More and more people want to put their dollars where they can have a true impact on society.
Right.
And we're going to see the proliferation of more funds and more indexed funds that people who don't have
Right.
large sums of money can actually partake in.
I think it depends on how many Ingers there are out there, as opposed to Sams and Ellens. And it's a great empirical question. So I don't have the empirical proof that there are lots of Ingers out there. I haven't done the measurement, but I do have my prior. I can only say my prior is that there are a lot of Ingers out there, especially probably in a younger generation more
Right.
so. And so then whether impact investing grows as a sector really depends on a few things. One, I think it really needs to be articulated as something different from ESG or
Yes.
SRI. That like cannot be overemphasized. Right now, there's so much confusion, even among academics and also among practitioners and among consumers. So that's number one. Number two, I think to help that distinction clearer, policymakers can play a role there. European regulators are a little, maybe a step ahead
Sure.
in trying to label Article 8, Article 9 funds. I don't 100% agree with exact definitions, but those are working definitions, and I think that's really great step to asking the funds to clarify themselves. What are you? You can't just say I'm a generic sustainable fund. What kind
Right.
of sustainable fund are you? SEC has started to move in that direction, but I think there's so much to do to get to a place where Inger and Sam and Ellen can just open up a website and easily find out like which are the right funds for me and reliably serving my objective. So to do that, I think we need to have a very clear labels and to ask the fund managers to actually commit to what it is that you're doing. You can't be like doing ESG one day and then impact another day and back to ESG the next day. That would not
Which
really
is happening now, right?
I think
mean, there are some investment firms that say this is an impact investing fund when in fact they're investing in ESG companies.
yes, I think the language is pretty mixed. And
Yeah.
maybe that's not totally a coincidence.
Indeed.
I'm doing some early work in that. I'm doing machine learning tools to read the text of what they say they do, and using machine learning models to categorize them. And
right.
we are in the early stage where we can code what funds into one of three types, but then we want to see what they actually do, and do they do what they say they do. So yeah, it's coming.
Well, Professor Yasuda, thank you so much for spending your time with us today.
It's
really
my great
appreciate
pleasure.
it. All right, this is John Byrne with Poets and Quants. You've been watching part of our Thought Leadership series at UC Davis Graduate School of Management. We're exploring the ideas, the passions, and the motivations of the top faculty here. Join us for our other sessions. Thanks for watching this one.